Josh Hoffman, our asset manager. There he is. Yeah, hey Josh, we got a pretty full house here. Actually. So, like, people are excited about checking out the dashboard and the insights. So I'm looking forward to it.
Yeah, thank you very much, Rob. Welcome everybody. It was a busy quarter. I'm just getting my screen set up to share. Apologies for coming late from a meeting right before this. Okay, everybody see this?
Yep.
Yep, okay. Give me 1 second. Okay, there we go. So for us on the acquisition side, again, welcome everybody. It's a beautiful day in New York. It's about 65 degrees. The inflation numbers came in better than expected. So hope everybody's having a great day. Over the last quarter, we were very, very busy. Closed 3 deals in the quarter proper, and another deal, Madison at Bear Creek, actually closed last week. So we're busy on the acquisition front and even busier on the underwriting front to get to this point. I'm sure everybody's, unless you've been buried under a rock somewhere, you've heard over the last quarter and before that the overarching theme and topic and headlines have all been about the exponentially increasing interest rates and state of the market. Even despite that, we're still bullish on multifamily and think that some of those factors only make the segment stronger. So just about the properties that we acquired here, Timberwalk and Madison are actually next door to each other. So we're hoping that they'll provide some synergy, mostly from payroll, maintenance as well, R&M. Five Oaks and Briar Court are on the north side and west side of Houston. Briar Court is actually pretty close to a property that we acquired in May, which was Broadstone Briar Forest. You can see the number of units here, vintages as well. Timberwalk and Briar Court, we were quite fortunate to secure really attractive rates, both from the same bank. So Timberwalk came in at 4.5%, Briar Court slightly higher at 5.25%. On the debt there, Five Oaks and Madison are both floating rate debt. Five Oaks is 235 basis points over term SOFR. Madison at Bear Creek is 275. And both of those loans have rate caps on them as well. Five Oaks is a 2-year cap. I believe it's 520 capped all in. And Madison has a 3-year cap, a step-up basis. But again, we're still bullish on multifamily. We think that the increased interest rates are going to potentially delay some construction as well. And so in addition to that, there will be people that don't want to take out a 30-year fixed mortgage at 7%, 7+%, who'll delay purchasing a property and stay renting. So there's going to be less supply, demand will increase as well. And so we keep looking to acquire properties here, and our acquisitions team is fiercely underwriting still and looking at Dallas and some other markets as well. But a very, very busy quarter. So jumping off the interest rate comment, one thing that we've had to look at, and speaking with a number of other sponsors they've looked at as well, is obviously the impact to cash flow from increased interest rate expense and potential escrows for rate caps as well on renewals. So we've discussed potentially delaying CapEx, potentially rearranging our budgets, and on some of these properties, honestly, a good deal of these properties, we are already hitting our pro forma rents or thereabout without running through the entire business plan. As you can see here, the Landing, which is our oldest current asset, totally completed. The other properties, with the exception of Timberwalk, which we just acquired in July, the exterior plans are pretty much all completed. Broadstone, there's maybe 1 or 2 items remaining. The other properties, we're just working through interiors, but we've had to push off some of the reno scope, particularly on Encore and Park, with respect to granite counters, just because several months ago when these properties were acquired, the bids that we were getting for granite were just astronomical. I'm not sure what other sponsors or investors have been seeing, but in a good sign, over the last month or so, we have seen from one particular vendor prices of granite come way down. And I'm not exactly sure. It could be for several reasons. Perhaps it's the supply chain and or perhaps other sponsors aren't moving forward with their value add business plans. So the manufacturer has a glut or a supply on their hands that they're trying to just dump. In any case, we're taking advantage of it and potentially looking to go back and add counters at these properties and Broadstone as well, where we've begun doing renovations, everything minus counters. So while we've had to reevaluate our business plans and look as far as the depth of the scope, we're still confident that the best path forward is to use our reserves to implement our business plan, roll out the value add plan, and thereby achieve the rents that we're expecting as a result, instead of delaying or hoarding cash or whatever it may be. And so some of these properties, depending distributions as a result, might have been impacted, but we still think it's the most prudent way forward to commit to our business plan and really drive the rents that way. So speaking of that, so if we look at Broadstone, just jumping into this is a property performance that we look at. We look at a number of different things on a weekly, monthly, quarterly basis, both from an asset management perspective and then property management as well. But here, so this is Broadstone. Let me just fix this. I'm not sure what the formatting has been slightly off with. So we use Power BI, and then this is loaded into Microsoft Teams. And even between these two Microsoft platforms, sometimes there's still some wonky things there. But if we look at other income, so this is a mix of items, obviously. And as of September, we are outperforming. The white line is actual, blue is our budget. We're outperforming our budget. However, in about 2 months, we will have an increased budget because we were planning on installing pet yards in a number of units on the ground floor, private yards, if you will. And after getting a GC, an electrician, and the whole 9 yards out there on the property to actually dig around, they determined it wasn't feasible with plumbing and electrical, and mainly due to a number of huge trees that would have had to be removed. So we've slightly deviated from that, and we're rolling out a more in-depth smart tech package. So thermostats, locks, common area access, and potentially some smart tech inside the house as well, similar to Alexa, a hub. So we're confident that that's going to garner the increase other income category, which would otherwise have been lost from those pet yards. And that's not related to COVID or anything else. That's just something that happened due to our business plan, but a way that we're adapting there. And then also just touching on that, this same category, other income. So there's some noise as we acquired the property in May. Other income hasn't really started building up, but there's also a lagging other income, mainly May and June, July, due to the accounting treatment of RUBS. So we bill back RUBS in all our properties, or the majority of them. And at closing, we get a credit, or we credit the seller. And so that amount goes onto our balance sheet, treated as deferred income. And so basically that other income is not hitting our P&L until it's all burned off. And as you can see, the reason for the jump here jumped 5% over the prior month was that the amount is finally burned off of our balance sheet and is now being reflected on our P&L. One other thing to note here are our rental losses. So July, we were beating budget, and then August and September, we were underperforming. And that's a direct result of this dip in occupancy, which happened. You don't need to really pay attention to this. It's quite noisy down here. This is everything by unit type. But so we dipped to 90%, and that's as a result of basically a net 13 move-outs.
most of which were expected. And as you can see, we quickly rebounded. The month after, we had 13 move-ins net. And then the following month, there was one net move-in, but quite a bit of turnover, which again, we expect when we're acquiring a new property. So 17 people moved out, 18 moved in right away. And as you can see up here, we're back up to 94.1, pre-leased at 97.1%. So it was a busy quarter. This was obviously, we saw this coming, but still doesn't look great to ever see occupancy dip like that. But being that we were focused and prepared, and the leasing team was working diligently, brought it back up quickly. And then just one other thing, just here in case anybody was looking at our expenses. So the rise in expenses here, it's not an error. We have it pretty much on most properties. July, there's just an extra payroll period in July. But in addition, we're expecting higher utility costs in July, August with the summer heat in Houston. And so that's the reason for this deviation or outlier there. It's not not an error by any means. So occupancy at this property rebounded. If we look at another property, for instance, Encore, similar. August, there were a lot of move-outs. This one particular unit type, which is a slightly larger one bedroom. So I believe this is called 750, and this is 820. Slightly different layout. And for whatever reason, tenants weren't too thrilled on it prior, but we focused on pushing those units, and now those are all 100% occupied. But again, in August, we dipped, quickly responded back up to 94.6% and call it 97% pre-leased here. And then at one of our older assets, similar to Encore, this was Hollister, was purchased in November. We have been really high, and we want to keep it probably about 95, 96%. We did dip slightly down, but we're back up to right about our target 95%. One thing that we will look at now is what happened here with these units, this 2x2 layout. But the thing with Hollister is it's two separate properties with a number of different layouts. There's two-story buildings and then townhomes as well of various sizes, 2-3 stories. And so there's just a ton of different unit types. So these huge drops, this might only be over 1 or 2 units. So it's not as drastic as it looks. So after our occupancy, we're looking at collections and seeing what's happening with those tenants that are living at our properties. This is Broadstone. This outlier here was due to a lockbox. This is a DACA account, but now everything's being reconciled as one. So money here is swept every week, and then also at the beginning of the month. But you can see we're pretty tight here. We ideally like, most of the money in by the 10th, ideally most by the 5th. And just note, this is the 10th collection day, not the 10th day of the month. So if we're looking at November here, it says the 13th, obviously today is the 10th. It's not possible, but our collection period starts on the 26th of each month. So if we're looking at just this actual month in real time, we're doing well. I mean, pretty vertical here. There was a slight lag here. This is just over a weekend. But if we're looking at all things being equal for the 13th collection day of any period, you can see the bottom number there is 307, which is the highest yet of any other month up to this point. So we're hoping that will increase. But again, just up to the actual day, the property is performing well. If we look at, so this is just a different representation of this to compare, but it also will correspond to delinquency, particularly if we look at Hollister. So again, this is a property that's occupancy is usually really quite strong. Delinquency is pretty much never that high. Even, I mean, these bars look quite high, and might be scary, but this is only 10,000. Still, we like to have that much lower than 10,000, but again, it's not 100,000. But it corresponds with this period here, which was August. So
We collected less, there was more delinquent. This has gone down as we're targeting those being delinquent. Here, it's really not something that we're terribly worried about. Obviously, we're monitoring it closely, but it's not a huge number, and we're confident that we will get this down lower. But it is a sign of potentially just inflation in general. Things are costing more. And so for different demographics and different properties, this is Solano. This is in Webster, Texas. Slightly different demographic, but here delinquency is a little bit higher. And so we think that inflation is more of an issue here. Again, with these months, people are going back to, or their kids are going back to school. So there's other bills to be paid, clothes, supplies, food, etc. And so one thing that we've just rolled out here as of last month is a flex payment system. So basically that works by a third-party vendor or this other company who will pay us rent up front, and then our tenants are able to pay in installments over the course of a month. Because one thing that we've had, or one comment that we've received as we've spoken to our tenants, is, we can't make the whole payment at once, or our pay period, or when we receive our checks, is not the same as when our rent is due. So there's a slight lag there. And so just to make it easier, we think both for us and for our tenants as a way to work with them, we're installing this program as a test. We've heard good things about it, but we'll obviously do our own due diligence and hopefully be able to give some feedback next quarter on this. But just a way that we're looking to manage this delinquency here, because obviously that's something critical to our business. So of our units that are occupied, so this might look like a lot, but it's looking at new rents. So this is new rents for the entire property. Yeah, so the title's cut off here, but this is new rents this is our actual rent over the entire property versus our market rent. So we're steadily increasing. We still have a gap here, about $68 a unit. You can see $68. Here was 79, so it's decreasing. And this will slowly creep up based on our new rents and our renewals. That's what we're more so focused on. But so for our new rents here, this is Broadstone once again. We're essentially at our market rents already. And we haven't renovated a great portion of interiors yet. So we're quite confident that when we do, we'll be able to push these rents further. We also have some other income items that we're adding, as I mentioned before, the tech package, RUBS, other income items. But here we're basically at our market rents already, and so we're going to push those higher. And if you look at renewal rents for the property, we're pushing on average over the last few months, $30 a unit, 46, 55. So we continue to push those rents there as well. Now that our exterior plan is basically done, there's some additional amenities, the property's in better shape. So we're pushing those on renewals. And we're also looking at potentially delaying renewals to really blow out our interior renovation schedule there as well, just so that we can command higher rents on these units, and just go for top line growth instead of waiting for, these particular tenants to move out. Because as we've done it so far, we've only renovated units at turn. So this property was acquired in May. If we look to Hollister, which was acquired in November of last year, here you can see at the property, we're basically property wide. We're pretty much at our market rents. We're $3 off, $4 off, $3 off. So we've pretty much maxed out here for the time being. And this is because our CapEx plan is pretty much complete. There's one additional item that's should be wrapped up soon. It was transitioning a old laundry room into a fitness center. And we're able to do that because we've added washing machines throughout, and there are still a few units that are needing washer and dryers. And so that's why we're still able to get higher renewal rents here. But the majority of the CapEx work is done. So we're close to our market here. Over the last couple months, we did have to offer a few concessions just on new rents. And so that's the reason for the slight lag here. It's $6 and $18 from our market. But prior to that, we had been pushing every month. So things that we look at for the property. I know I'm going fast. We can answer questions at the end. I admittedly am not great at multitasking. It looks like there are quite a number of.
So you're all good.
Perfect. Yeah, thanks, Rob. Much better at being a multitasker. So this is the property management side, leasing side, and this is Hollister Apartments. You can see that the majority of the leads, I mean, it's not even close. So this is just leads in aggregate over the month and by source. But you can see the majority of them are coming from this apartments, I believe apartments.com, yes. And then what does that actually turn into for showings, applications, leases? I mean, you can see here, they're accounting for a great portion of turning into actual showings. And then from there, you can see the different conversion rates, showings to leases, showing applications to leases. So just from apartments.com in September, we were over 50% showings to leases, which is great here, 58% showings to leases there. I mean, it's not the huge portion of actual leases, but just the conversion rate among that source is great. Here, we get much less from drive-by, but they do turn into, they do have a good conversion rate of them. I mean, they're not accounting for a huge portion of the actual leads, but they do turn into leases. And what's interesting here is that the property is it's segregated in terms of there's a road in the middle, and then there's brick walls as well. It's more of a private residence, and there's gates that you have to go through. So you can't really see the entire property. In addition, it's on a more of a side street. There's not a ton of drive-by traffic. So the people that are driving by, if they're going in, it looks like they're being, they're interested and they're serious, and they're moving forward with actual applications. And hopefully they're qualified, well qualified, and then turning into actual leases there as well. Here's the slight dip that corresponded with the delinquency before that we mentioned. And you can see that our renewals just over the last month jumped up, but we're continually looking at our renewal percentage as well, how many units are expiring and what percentage are we capturing. If we look at Broadstone, so this is a larger property. Hollister is 156 units. Broadstone is 342 units. And on a busier area. And as you can see here as well, a large portion of leads come from apartments.com. Again, there's a number of apartment websites here. This one actually is interesting. Abodo, similar, but they've just over the last few months, it seems like, I mean, I've admittedly never used this service, this website, but for us, it's turning into leases without even actually people going to see the property, September and October. So turning into a good source there. But if we're looking at apartments.com, this as well is turning into a good source of showings and leases. And so that's one reason that we're using this property as well to roll out a larger tech package, just because we think that's indicative of the demographics. They're using the internet here, which in this day and age is not a huge issue. Pretty much most people do, but it's doesn't happen at all of our properties. But Hollister it does, Broadstone it does, and so those properties, Hollister already has smart tech. Here we're rolling it out as well. But in addition, this property shows very well from the street, and so it's hard to see, but drive-bys are this category. And so they're turning into showings here. And I think, so this is one thing that I'm going to follow up on just looking at this. I think drive-by and walk-in might just be a little semantics, basically in terms of how our property managers are classifying leads, because I think they're pretty much the same thing, but you can see walk-in, drive-by is really accounting for a great portion of the actual showings, leases as well. And that's indicative of all the work that we've done to the exterior of the property, adding amenities, making the amenities more attractive, and then just increasing the curb appeal from the street, making it a more inviting property than it was before. And it's showing really well against the other properties in the area. And if we just look at this other property, so this is Solano. But you can see here, it's a real mixed bag. I mean, we're getting everything, a number of different websites, so not as tight as a Hollister. And so different demographics, we focus on different things, but just indicative of each property is different. Each one will have different strengths or ways to capitalize, things to capitalize on. And for Broadstone, Encore, Timberwalk, which is our newest property that's in here, Five Oaks and Briarcourt will be up next quarter, but they were acquired basically at the end of the quarter, so they're not in yet. But here you can see, so this was expected. We inherited a number of tenants that basically were delinquent. This is a number of evictions that were filed. We're really working on getting this back up, confident that it will. But just the different scenarios at play for each property. And again, here dipped in March, way back up, focused on that. And this property, we haven't done a huge number of interior renovations either, but we're already getting our market rents. So we're potentially looking at, do we save some meat on the bone for a potential future buyer? Do we take the money that we have in reserves and just keep it in reserves rather than deploy it for CapEx? Here we have all of our CapEx funds, but for a number of our other properties, CapEx funds are held back, which in this rate environment is a great thing because we're not paying interest on that. We're only paying on our actual funds that have been deployed, not the entire notional amount. So they were really happy, but we're still moving forward with our CapEx plans at those other properties. And lastly, moving into next quarter, which we're already in, we've started CapEx on Five Oaks, Briarcourt, and just beginning on Madison at Bear Creek. Five Oaks and Briarcourt, a majority of the exterior work has already been scheduled. Some of it's been completed. Interiors, so Five Oaks and Timberwalk, those are the properties that I mentioned. We got huge discounts on granite. And so we're going to leverage those bids to potentially add granite to Briarcourt and maybe Broadstone as well. And acquisition wise, we are looking to get into Dallas. We're currently doing due diligence on a property in that MSA, which would potentially close in January of 2023. We'll share more details as they become available, but we're still in a due diligence phase there. And going forward, I mean, we're just going to continue monitoring the interest rate environment, looking at inflation, looking at a possible recession. How bad is it going to be? It's anybody's guess. I mean, Goldman Sachs said it wasn't going to be so bad, I believe, over the last week, but other people are saying it'll be severe. So just keeping our not our blinders on, but committing to our business plan, huddling up internally and saying what's the best for each individual property and the portfolio as a whole, and then responding to other systemic issues and system-wide issues as well to decide on the best path forward. But by and large, we're committed to value add, committed to multifamily. It was, some properties, it was a rough quarter, but we made it through and still quite confident in these properties. They're all cash flowing. And yeah, take the charges or the challenges head on and move forward. But I've spoken exactly 30 minutes or thereabout. I don't know if anybody has questions or anything you want me to touch on or Rob to touch on, but that's basically all I have to share with you. I hope it was informative or somebody got something out of it.
Yeah, that was perfect. Very good information, very succinct. Thanks everyone for being on and tuning in. Got plenty of time for Q&A on anything you saw here, or if you have more general Q&A, feel free to put those questions in the chat, or you can unmute yourself at this point and ask it live.
it's a lot of information to throw out at once, and don't want to go so fast, but again, in the interest of time.
I can go. What are you seeing on interest rates, and are you doing bridge loans, or are you doing agency into 2023?
Yeah, so for new acquisitions, bridge loans are pretty much off the table, just given the pricing of bridge loans. It's just too difficult to make the numbers work with that high of a rate. So we have been looking at, I mean, we're bidding on a lot of stuff, and our base case scenario, I'd say at this point, when we're underwriting a new opportunity, is agency financing, using a fixed rate actually, which it's a bit of a controversial time because yes, interest rates have moved up a lot and they're likely to stay elevated, but there's also, you know, some believe, there's some thought that they will go down in a year or two. So the idea is you may benefit from floating today and be able to ride it down. And conversely, if you fix today, you may be fixing at a relatively high rate, looking, you know, if you're looking back 2 to 3 years from now. The trouble with that calculus is the cost of rate caps. Rate caps right now are extremely expensive, and those are a requirement when you're doing floating rate debt. The lender forces you to buy an interest rate cap. So that cost really weighs on the total cost of your floating rate. So long story short, we are looking at a base case scenario of fixed agency debt with some wrinkles in there. And by and large, when you underwrite with that assumption, we're coming in way below pricing guidance, and that's what causes the dysfunction in the market today. So really the few ways to make deals work today are loan assumptions, where you can assume the seller's in-place debt that's in place at a lower rate. And also in a more rare scenario, you can find seller financing, where the seller is willing to extend you a loan, where maybe you are willing to pay their higher price in exchange for them providing you more favorable debt terms, and they're the lender themselves. So yeah, there's that's how we're viewing the market right now.
So you are you putting together deals that are agency loans, fixed agency loans? Are you able to make any deal work with that?
Yeah, I would say, I mean, us at the moment, no. I would say that it is nearly impossible. So I would say you have to wait at least 6 months for something like that to happen. I mean, I'm sure there's the off deal where you can get in at a high enough cap rate to make it all work. But by and large, there is a bid-ask spread in the market right now. So we're being very, like Josh said, aggressive and proactive. We're starting to see an uptick in brokers reaching out to us about desperate sellers. And the reason why I say they're desperate is because they're desperate to sell at their price, right? They're not desperate to sell at the market price. So they're not really truly desperate. And that's what's preventing deals from happening. But loan assumptions are something that we are screening for heavily, as that is, like I mentioned, the best way to make deals work today.
So you said you're focused on value add. Do you do any B and A properties?
No A, not necessarily we wouldn't, but just we don't own any A. We own the youngest property in our portfolio is a 2008 vintage deal, but given its tenant demographic as well as finishes and construction type, I would still call it a Class B asset, even though it's a 2008 vintage deal. So we really play in the B and kind of C+ space.
Thank you.
Yeah, you're welcome. Yeah, if anybody has any other questions, feel free.
So you mentioned in the chat, answering my question about the software, that Josh built this himself using Resman. How complex? Sounds like it's a very complex job. How long did that take to build this software program?
I mean, the visualizations themselves are not don't take a ton of time. It's more the back end data. So, and it's getting the data from Resman exported. Power BI, there's a little, I guess, discongruency, I would say, incongruency about exporting data from Resman. So we have been doing it manually using VBA macros to clean data, CSV files that are exported from Resman. We, for a while, were trying to connect to their API key, and we're able to do it. We're able to do it via Python, but it's still, it only gets the data to an external database. Connecting it directly into Power BI has been a slightly more complicated issue, and it really shouldn't be. We're not sure the exact quirk there, but we're working on that. But yeah, I recommend it. I mean, it's maybe slightly less intuitive than some other software, but yeah, not terribly complex. Once you have it set up, then you can just populate. But it's the ETL process, extract, transform, load, that takes up the majority of the time.
Have you considered selling this software, or if you haven't considered that, do you know any alternative software that we could buy?
Yeah, I mean, we can connect afterwards. There's some other software that do similar things. But I mean, yeah, you could build this yourself using other software potentially. But there are certain other vendors out there that'll help you visualize data. There's independent guys as well that can do this. They do it for a living. So there's many talented people, and we've spoken about potentially leveraging this for income as well, but haven't got to that point yet.
Hey, Rob and Josh, Randy Smith here. I've got a quick question, if I could.
Sure.
Yeah, so it sounds like Madison and Bear Creek is probably one of the last bridge lending loans that you'll be using for quite some time. Can you talk to your comfort level in that specific loan and how it will support cash flows and what you anticipate things to look like at the end of that current rate lock?
Yeah, so Madison is actually not a bridge loan. It's a bank loan. So, and sometimes those can look pretty similar, but in this case, it is actually fairly different. So the most traditional bridge loan would be a 3+1+1 bridge loan, which just means the initial term of the loan is 3 years, followed by 2 one-year extension options. And also characteristic of those types of bridge loans is usually a higher leverage point, whether somewhere around 75 to 80%. So on Madison, we are at in the mid 60% loan to cost rather than 75, 80. And then instead of having a 3-year initial loan term with 2 one-year extension options, it's just a 7-year term. So 7-year term is more, it is permanent financing. It is more long-term. And the rate is floating on that. So most bridge loans are floating. So it has bits and pieces that are kind of similar to bridge, but also more like permanent bank debt. And as far as cash flows, we are purchasing an interest rate cap, or we have already purchased an interest rate cap on Madison, which puts a ceiling on the rate at 5 3/4 for the first couple of years. So we're going in at right around a 5 cap. But because there's so much value add opportunity on the deal, because we're buying what we bought from a long-term owner that hadn't touched the interiors in over a decade, we've got nearly $200 of pop in the rents. So we're getting in at a 5 cap, but through the business plan, we're able to push that into the mid 6s. So if we have an effectively fixed rate through the rate cap at 5 3/4, and we have a 6.5% operating cap rate, that creates positive leverage for us to have to have good cash flow. So that is, that's the game plan, of course, to create value as quickly as possible and get into that positive leverage territory. And then the hope for year 3 on that deal is that by then we'll be seeing some reductions in the interest rate due to the Fed lowering rates, and at that point, we will have created value as well. So we can look at a refi into lower rate debt, potentially at a lower spread. Or if we need be, we can stay on the loan for a longer term because we have the 7 years of term. And what we would just need to do is purchase a replacement cap for years 4 and beyond.
Great, thank you.
Okay, well, very good. Well, thanks everyone for sticking around to the end. Greatly appreciate the questions. And thanks again, Josh, for another great portfolio analysis webinar. We will see you guys either next quarter for the next round of this exact same webinar, or we'll see you for one of our other webinars, whether it be the acquisition analysis, our trade tracker webinar, or in one of our one-off webinars. So we'll see you soon. Thanks a lot.